Right now, the market's caught in a repeat pattern, and it's one that my contrarian screen flags at least a dozen times a year. This time, Monday.com stock is the target. Now, when this pattern emerges, you get one of the easiest and most controversial trades in the market, the regression snapback. Now, I know you've heard this one before, don't catch a falling knife. But contrarians like myself set up screens and wait for this type of trade. And over the next several minutes, I'll show you exactly how to copy my screen, including a 3-step filter so you too can invest in compounders while they're on sale. Okay, so back to why we're here, the repeating pattern in the market. You see, I've seen this over and over again over the last 15 or so years. Stock drops on fear. Fear proves false. Then a massive relief rally takes over. More times than not, it happens within 3 to 6 months. The stock bounces back to pre-fear levels. That's a regression. One, that's an easy 30% or more for starters. But you also get something much, much better. A deeply discounted cost basis and a proven compounder. And right now, the market is terrified. Terrified that big tech will crush small tech, as I call it. In Monday.com's case, Google modified the algorithm, and Monday.com drops more than 20% when they bring it up on their earnings call just for conservatism. You see, this big tech fear hits at least a dozen stocks every year. It's like clockwork. The only question is, which stock is next? Let's go down memory lane. Reddit, Q4 2024. Google tweaks search. Stock crashes 15% after hours. 3 weeks later, traffic fully recovered, revenue up 71%. And the stock rebounds like nothing happened. We can go even further back. Overstock, 2015. Google's algorithm wipes out a third of search traffic. Stock plummets 18%. No patience shown at all. You'll see this common pattern. But in this case, 6 months later, SEO fixed, revenue recovered completely. I'm not done. We can keep going. It's a long list, but we'll keep it brief. Remember when Amazon launched Handmade to target Etsy's business? Well, that new venture caused Etsy stock to drop 40%. Handmade ended up getting 500,000 listings. Etsy adds more products in 2 weeks. You see, after that, the stock goes on to multiply like nothing happened. But let's keep going down memory lane. Remember when MongoDB got cloned by Amazon? Well, the stock dropped 15% in 3 days on that news. They went on to post over 70% revenue growth. In the very next quarter, stock went on to more than double 6 months after DocumentDB. Let's just go over a couple more because we really need to prove this big tech fear is real. Remember when Facebook Rooms launched, the Zoom competitor? Zoom's stock ended up falling 12% on this launch in April of 2020. Last check, it doesn't even exist anymore. And we know what happened to Zoom stock afterwards. How about when Roku crashed 27% when Apple TV Plus was announced? But growth never stopped and the stock bounced back. So we can see this pattern is clear and there are many, 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 many more. But I'll just stop here because I think I've made my point. Now think about this. This is what I want you to think about. The same people panic selling Monday at $250 today will panic buy at $350 tomorrow when Monday keeps growing like nothing happened. You see, this is a wonderful trade because status quo becomes the catalyst, and that's the opportunity. You see, the market creates fear. Then it creates its own relief rally. And my contrarian screen is designed to catch this exact situation, and I've been using it for a decade plus. But how do we know this isn't different? How do we separate real threats from false alarms that create these opportunities? That's where my divergence test comes in. But first, before we get there, we need context. Pull up Monday's earnings call. Once you go through it, you will see there is a treasure trove of insights hidden in plain sight. How did they handle all of the Google questions? Defensive, confident, data-driven, qualitative? Monday's CEO didn't flinch. I mean, you can just take a look. They're still exceeding 2025 guidance that they gave at the top of the year. Their new CRM product just hit 100 million ARR in under 3 years. That's a major benchmark. The reality is Monday is launching enhancements like nothing is wrong, because for them, nothing is wrong. So that's signal number one. Now we can get to the divergence test. First check, earnings history. We can see that Monday's beaten revenue estimates quarter after quarter. Just look at the consistency. We can see they've beaten earnings estimates quarter after quarter. That doesn't happen by accident. That's proof, among other things, that management knows the business cold. Second check, revenue growth. We can see that Monday is still compounding at high rates year over year. I mean, sure, it's not the 50, 60, 70, 80% hyper growth that they've had, in the past, but this is what durable growth looks like. It's the law of large numbers. You can't keep growing at 70, 80%. The reality is customers are still buying, still expanding, still choosing Monday. This is the real world. Third check, margins. We can see that Monday's operating margins are clearly experiencing structural growth towards profitability. The reality is you don't get that kind of operating leverage if your business model is broken. And the fourth check, short interest. When shorts pile in, they suppress the stock price. But when they're wrong, this forced buying creates rocket fuel for a snapback. And so we can see that Monday's short interest is elevated. It's not extreme, but it's enough. So as we take a step back, that's 4 tests and 4 confirmations that there is a clear divergence between the business and the stock. The divergence is clear. But I've got one more filter for you, one that will seal the deal, the flywheel impact analysis. This is a powerful tool that you're going to want to use as you do your own research for what should or shouldn't be in your portfolio. You see, every scaled business has a flywheel, a self-reinforcing cycle driving compounding. Side note, I strongly encourage you to check out Jim Collins' work on the flywheel. The crux of it is this. Once a flywheel spins, it creates its own momentum. Now, the question today is, can Google's change break Monday's flywheel? Because if not, the threat is fiction. So here's Monday's flywheel. A fast time to value hooks new users. Those users invite their teams. These teams centralize workflows through integrations, where one win opens up multi-product expansion. Think CRM, dev, service products. And then finally, enterprise standardization locks in. And that's how Monday gets into the ecosystem. You see, each turn makes the next turn easier. So we can see that Google's algorithm, it only affects discovery. Discovery is important, but that's not a part of Monday's flywheel. You see, travel sites like Expedia, retailers like Wayfair, they live on generic Google searches. Algorithm changes can definitely cut directly in the business. Now, these are world-class leadership teams, so they can respond and adjust. But in Monday's case, this is B2B SaaS. Let's do the check. Time to value of Monday's products, still instant. Virality happens inside of the product. Expansion, that's driven by success, not SEO. Enterprise standardization, that's from outbound sales, not Google. So what do we have? Monday passes all filters. The market just handed you a playbook moment. Importantly, you now have the tools, context check, divergence test, flywheel analysis. These tools work. They've been working for me, again, for over a decade. I strongly encourage you to watch my trade desk analysis where the screen catches another one. You'll see same pattern, same tools, same outcome. And remember, use this anytime you see big tech fear. This is not the last time, probably not the last time this quarter, and definitely not this year.